only for consultation purpose of the holding company, we will prepare accounts and IND-AS. Lot of money, right?
Since we have to do the reconciliation, so that we have to define that.
Okay, slide number 17. Now, whenever we say the rights have to be substantive, right? If the rights are not substantive, then those are not the rights. Now, what do we mean by substantive? Substantive right means the rights should be exercisable on the day when we are making the assessment. So, if the rights are not substantive, then there is no control. So, for example, if there are barriers, if you are not able to exercise those powers which are with you, then those rights are not substantive and the control definition will fail and you may not be able to consolidate. Just to give you an example, we took an example of potential voting right, where convertible option gives you more than 50% option or more than 50% voting. You have say currently 40%. You are holding convertible debenture also, and because of convertible debenture, the conversion option gives you 20% additional increment power, right? So your holding will go up from 40% to 60%. Now, if that right is non-substantive as of now, you will not consolidate. The non-substantive could be on account of various reasons. The pricing, the option price what you have, exercise price, is much higher as compared to the current market price. If that's the case, you are not going to exercise, right? In that case, the right becomes non-substantive, right? Similarly, if the investment is going to ask for a commitment, a big financial commitment, and you don't have financial ability or financial power to raise money in the market because of whatever circumstances, because of your industry is in a downward trend or because of your own created risk, then those rights become non-substantive. Okay, coming to return can be positive, return can be negative, right? Or it can be positive, negative both every year, but it has to vary. If it's a fixed return, then the definition will fail, right? If you are giving amount or if you are controlling and investing, but you are getting in return only a fixed percentage, then the condition of power will fail. The return has to be variable return, right? So what are the examples we have seen? Dividend, value changes, economic benefits in terms of lower cost or economies of scale, remuneration, management fees, tax benefits, synergy, cost saving, economies of scale, everything, right? Now, you may derive benefit, that's one. What is not relevant is non-controlling interest also enjoying benefit, so that's fine. As far as you are concerned, you should be able to enjoy benefit, right? Return that appear fixed may actually be variable, right? Sometimes returns appear to be fixed. Just to give you a classic example, if an investment is given or if a loan is given, fixed loan with a 12% fixed interest, right? It's a fixed return, there is no variable, isn't it? Yeah. No, the answer is different. Even though it's fixed 12% return, the 12% return may not come to you because of the credit risk, right? The other party may default. The standard says, in that case also, the return becomes variable because you need to assess the variability of credit risk also. So, return might appear to be fixed, but it can be variable. Only in case of where the loans are given in terms of secured loan, and when it is properly backed by security, in that case the return can be fixed. But otherwise, the fixed return also actually can be variable.
In spite of the loan being serviced properly.
Sorry.
In spite of the loan being serviced properly.
No. So as of now, this trigger will come. So it's not. It doesn't mean that if the loan is given without security, it means control. Only in situation arises, you have to see this.
When you saying a fixed can also be considered variable because of certain condition attached to the loan, or because of other factors which may affect the profitability?
Because of the other factor. For example, in this case, when we have given loan has got a fixed rate of interest, say 12%. But the other party,
no condition attached.
No condition attached.
Okay.
But it is unsecured loan.
Yes.
Right. So I have given you 1,000 rupees with a condition of 12% interest. The return appears to be fixed. But in 2 years down the line, you may default. So I may not get 12 rupees back from you. So that credit risk also changes my return. So
Such factors will be there everywhere.
yeah, right,
But there is nothing like this.
right.
It's only if there is profit, otherwise there is no.
Right. So in all these cases, you will able to meet the definition of variable control or variable blue. So now only, I mean, it doesn't mean that whenever there is a variable return you will consolidate it, but it will help you in consolidating. Bottom line is that.
Other than return, we have to take the other parameters also.
Yeah. So if both the conditions are satisfied, variable return is one, but yeah, control is also second. That means in terms of power ratings, all of the conditions are satisfied, then it's I think sir, you had raised a question. Well, franchise or consolidate, right? For example, take a classic example of Burger King or McDonald's of the world, right? Just to give you an example, McDonald's or Burger King, very few of the stores are actually operated on their own. So when you say McDonald's globally, as per the trend, I think only 15% of the restaurants are owned by McDonald's Corporation directly. 85% of the restaurants are running on a franchising model, right? So I am a McDonald's Corporation, you come to me, I give you McDonald's board, you do your own business, right? Only thing is, I control you just to safeguard my quality parameters, right? So I have my standard that you need to have quality parameters fulfilling my requirement, right? Otherwise, you have liberty to do anything. In that case, there is no control, right? But you are coming to me as a franchisee. I am giving you franchisee, but I have right to fix the selling price, right? So, for example, in McDonald's, it operates in Hard-to-Sell restaurant. Now, Hard-to-Sell restaurant operates many restaurants. Now, a franchisee comes to McDonald's and says, I want to take your franchising. If the conditions are put that all the product approval, whatever I give, only those you can market. The prices also will be fixed by me. You can't raise date without asking me, right? If those conditions are attached to it, then it will become control. In that case, that franchisee will have to be consolidated fully by McDonald's or Burger King, right? So in that case, what will happen is, suppose there are total 100 restaurants. Out of 100 restaurants, 70 are owned by the corporation directly. So those 70 are fine. The remaining 30, which are under sub-franchising model, no equity investment, zero equity. It's a purely franchising model. The entire equity is owned by Mehta. In that case, even though there is no equity, but because of other rights, where I have the McDonald's gives the right of fixing the price, of capital structure, everything, it will consolidate entire revenue of 30 restaurant, and the remaining profit, what is earned on those 30 restaurants, will be allocated to minority interest.
So typically what happens for all petrol pumps, when you say all petrol pumps, because of that, is basically controlled by the HP.
Right, so only the pricing is controlled by the HQ. But if the other conditions, if the home to appoint as a local file, whether to borrow fund or whether it has to be equity contribution, if those decisions are taken by the respective franchise, then it is fine. If suppose
Not just the pricing, but
pricing is one, but you have to look all the conditions together.
various franchise or various model.
Yeah. So the accounting would be different. In some cases you might consolidate, in some cases you might not consolidate. Yeah, that will be it. But both the conditions have to be satisfied. So return has to be variable, and also you have a right to govern the relevant activities. Return has to be variable. Right. So generally, what I have said. Right. So what I have seen practically, working on Burger King as well as on McDonald's, they have control, but those controls are limited only to quality parameters. So you cannot introduce a product without approval, and you have to maintain the quality. So the suppliers will be fixed. That you cannot buy material other than the supplier. Those parameters are there only from ensuring quality perspective. Otherwise, the other companies, the parties have right to from where to borrow, how to borrow, or to where to open the store. So those decisions are taken by the local company. In that case, there is no control. But in other cases, suppose if all the rights are also enjoyed or controlled by the main company, then there will be control.
Even
Even-
there is a significant influence by the say burger on the franchisee, then it will be then they will need to consolidate.
Well, okay, so,
Otherwise, no.
but okay, so not significant influence, but if you are meaning control, if all the relevant activities are controlled by the franchisor, then there will be consolidation.
The appointment of employees.
Appointment of employee could be one, but apart from that, many other.
Selection of the location.
Yeah, so in that case,
This will not be applicable.
Even design also,
Let's say
even design also, design also.
case of this franchising, they give the recipe, you cannot do anything, the quality has to be used. If you try to see virtually, I am in the control.
right, so no, so one two things now. For example, now let's take,
The globally we have the standard recipe, standard parameter which we have to follow.
right,
Also, yes. So,
Not all, yes.
I may not be controlling that equity or may not be controlling.
So just to give you an example of McDonald's Corporation USA and Hardcastle Restaurant in India. Now, there is an agreement between McDonald's Corporation USA and Hardcastle Restaurant in India. What the agreement says is very limited to product specification. If you introduce any product, you need to take my approval, right? Otherwise, there are quality parameters. You need to have quality parameters of this. Otherwise, all the authority, all the responsibility is given.
Recipe itself.
Yeah, but otherwise, even the Hardcastle Restaurant in India has the right to introduce any product. It can introduce. So, for example, if you see the products of India, what they sell in India and what they sell in US are completely different. So you won't find whatever aloo tikki, yeah, exactly. You won't find aloo tikki in any international market because that's a product developed by Hardcastle Restaurant on its own. Yeah. Only thing is, it still requires approval from McDonald's Corporation, but finally it's using brand name. So that control is only protective to ensure the brand name of Hardcastle of the McDonald's Corporation. But finally, what product to introduce, what price to keep, where to open a store, all whether to borrow or whether to put own equity, all these decisions are taken by Hardcastle Restaurant locally here. In that case, the consolidation will not be applicable for the McDonald's Corporation. Now, having said that, if Hardcastle Restaurant in India say has 300 restaurants, it opens another restaurant. So 300 restaurants are opened and managed, controlled by Hardcastle directly. In airport, there are rules. Anyone cannot enter. You need to go through a tender. Whosoever wins the tender will only be able to open it. In that case, even though Hardcastle is running its own operations everywhere, just to open a restaurant in airport, it has a franchising model. But under that franchising model, it keeps all the conditions. You cannot introduce any product. You cannot fix the price. You cannot borrow the money. You cannot do this. Then in that case, that restaurant which is in airport will be consolidated by Hardcastle. So depending on the circumstances, answer can change. No. So since the McDonald's Corporation does not control Hardcastle, it does not consolidate. What McDonald's does is McDonald's earns royalty income. It controls them again. Yeah. So if it consolidates, if the control is triggered at that level also, then it will consolidate Hardcastle Restaurant also and the company which is opening the restaurant in the airport also. So this will be all, this could be applicable in McDonald's cases, or it could be applicable in those ice cream cases. It could be open in classes also. For example, GK Shah. GK Shah will be brand name, but otherwise it will be all run by other person. So all this, wherever it's a franchisee model, you have to see what are the powers enjoyed by the franchisor, and depending upon what are the powers enjoyed by the franchisor, consolidation might get triggered or may not get triggered at the franchisor level. Okay, what are different type protected rights we have covered? Power with less than majority voting rights. We discussed that with 47% also, the company may be able to consolidate. Potential voting right we have covered, delegated right. Or specified set silos, so that will cover subsequently. Okay, so another new concept, de facto control. So control we have seen. Control is where it is established that there is a control. Now there is a concept of de facto control also. So same example, like where is a de facto control? You are not having exclusive control, but others also don't have control. the other holding is widely spread. In this case, for example, 53% is widely spread across, and no one is able to come together to outvote you. In that case, with 47% also, you are having defect of control, right? Just to give you an example, first example, 48% is owned by A, and remaining 52% in B is widely spread. In that case, A has got a control. Example B, where out of 100 only 45% is enjoyed by C, and there are other 5 investors. 2 investors holding 26% and other 3 investors holding 1%. Is there a control?
No.
No. Right. So exactly. Right. So see, the holding actually remains more or less same, 14%, 45%, but the answer can change because in the first case, the 52% is widely spread across lakhs of investors. Whereas in the second case, only the 2 investors, if they come together, they can have a majority, and then they can easily outvote company C, right? So with just 2 investors coming together, company C cannot take any decision. In that case, C cannot control. There is no control. Example 3, where J is owning 35%, 3 investors are holding 5% each, and remaining 50% is widely spread, out of which only half actually come for the AGM, right? So what happens is, in this case, 50% is held by 4 investors, remaining 50% is widely spread. Out of that, only 25% of that 50% actually comes for the AGM. Remaining 25% are actually never attending the AGM. In this case, what happens is 25% of the widely spread plus this 15%, 40% plus 35% of J. 75% is the total voting powers exercised every year. To have half of 75 is 37.5, right? Entity J only has 35%. It means there is no money. So reassessment every year, depending upon the situation every year, you will see.
So the attendance is considered at 40%, 35 will become majority.
But what you will do, sir, is you will not see situation of only 1 year. In assessing also, you have to see past trend of multiple years. So you have to see 1 year could be exception, but by having analysis of say multiple years, then you will reach to a proper
So the trend of last 2-3 years,
last 4-5 years.
you have to rely on
Right. So a lot of work for auditors actually. And again, there are a lot of
we have paid for it.
Yeah.
That's going to be the most difficult.
Right. And with e-voting, again situation changes, So till now it was fine, it was AGM. Now with e-voting, the percentage of voting actually can drastically change. So you have to see kind of factor all these cases, Again, the standard says very clearly, so the defective control has to be applied only when there is a proper comfort. If you have a doubt, smallest doubt also, then the standard says if you have a doubt, don't apply defective control. Right? So in the first case, it was very clear. 48%, 52% is widely spread. There is no doubt. You can consolidate. But in other cases, whenever there is a doubt, don't consolidate. Again, audit challenges, as I said, that remaining is widely spread or not widely spread, and every year the system will change. There have been audit challenges. Some of them listed. I will not actually take all because of
Doubting case in mind of management or doubt in mind of
So very subjective.
both. So auditor and management both will have to do its independent assessment, and finally both have to marry each other. Okay. Potential voting right we have seen. Again, what are the conditions and why the potential voting rights? What will be the implication of potential voting right? So, as you said, the exercise price or contingent price. If that is favorable, then it is fine. Then those become substantive. Otherwise, that doesn't become substantive. So, if you see slide number 27, the criteria would be exercise price. If the exercise price is deeply out of the money, then those are non-substantive. So, say if your exercise price is 1,000. Currently market price is 1,500, right? Consistently. Definitely you will exercise that option, right? It's in the money, you will exercise, the rights are substantive. But in case if the price is only 500 and your exercise price is 1000, and the market price of 500 has been constant for a longer time, then you are out of the money and you are not doing the exercise. So those right becomes non-substantive. Financial ability to exercise. You have the right. Those rights are actually favorable. They are in the money. But you don't have financial ability to exercise. So for example, Kingfisher, Vijay Mallya. Vijay Mallya currently might have a option to say invest in say Bangalore chemical. I mean, as of now it's sold, but anyway, just to give you an example, it has a right. The price of Bangalore chemical is also high as compared to its exercise price, right? Its price under the agreement. So it's favorable if exercised. But Vijay Mallya does not have money. No banker will be lending the money. In that case, there is, even though the prices are comfortable, prices are positive to you, because you don't have power to exercise this option, this rights will become non-substantive. And exercise period. The longer the exercise period, the rights are non-substantive. So you can exercise this right only after 1 year, which is a very long time as of now. It might be non-substantive. But if it's exercisable now, then those rights are substantive. Okay, next slide. Actually, this is again a small example, straightforward. I will not take time on this. We already discussed this discussion. Again, slide number 30 is also what we have discussed. Whether we basically consider all the factors, whether it is directly out of the money, whether it is currently exercisable, and based on all this assessment, you will take a call whether the rights are actually substantive and whether the control is triggered or not. Delegated rights. Now, there could be an agent who might exercise few of the rights, right? So, for example, classic example of PMS, portfolio management services, right? Where a person contributes, or where many people contribute, say 1 crore rupees, 100 people come together, everyone contributes 1 crore, there is a 100 crore pool, and that 100 crore pool has been given to another company. That other company can make decision of buying and selling, right? If those rights are exercised without any condition, then it has got a power. But if the guidelines are given and the decision making is very narrow for the person to make decision, right? Then that person is becoming agent, and then it will not consider it, right? So again, principal agent relationship also actually quite important. So again, the principles are laid down, but now you have to see situation of each case. You have to make your own judgment whether the rights enjoyed by the third party are actually broader, whether it is working as a principal or whether it is working as an agent. So for example, in a portfolio management services, if all the decisions are given to a third party, where say he says, I'll buy, I'll sell at my own wisdom, right? And whatever profit is done, we'll share equally, right? In that case, he is working as a principal. But on the same hand, similar situation, if the strict guidelines are given, like you can do buying and selling only for company A, B, C, D, E, F, right? You will not do buying and selling, say, if the prices fall below this, right? If the revenue will be shared in terms of only 5% of your income or fixed charge, which is like 5 lakh rupees a month, which is commensurate to market terms. Those circumstances will basically suggest that you are working as an agent. So you are working as a professional, not as a principal, right? So all these conditions, the decision making power, how is getting remunerated, everything will have to be considered together to make a decision. So at times it is difficult. So few of the things, like